Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here's your host, Mike Alkin.
It's Monday, January 28th, 2019. Thanks for listening. Hope your weekend was as relaxing as mine was. Started off, had my Friday night hockey game at 11:15 to 1:15. Had a buddy of mine who came and joined in. Now, I play open hockey, so it's not part of a league. This is just 11:15 to 1:15. Just a bunch of guys, 15, 20 guys, hopefully more sometimes. We always have a couple of goalies at an old indoor rink that we play, and it's 90 minutes running time, and the first half hour we're just skating around, just a bunch of 40 to 55-year-old guys trying to get loose, with the occasional 20, 30-year-old that comes down and plays. But I stopped playing in the house leagues and all that stuff a while ago. But a buddy of mine came down who plays twice a week. He plays it's a country club for hockey that's out here, and I don't belong there. He plays in organized leagues with the uniforms and everything. So, but good hockey player, a good buddy of mine. He came down and played, and he texted me at about 9:45. He said, "Hey, I want to come skate." I said, "Great, see you there." And at that time, when he texted, I was stretching. So I was watching, I think, the skills competition of the NHL All-Star game, and so I leave my house at about 10:40 because it's a 10-minute ride, 15-minute ride. And what I've noticed going back now for a while is reminds me of the movie Top Gun when Maverick went out and saved Iceman. Who was it in the very beginning? Maverick in the opening, he went out. His buddy freaked out, and he went out and brought him back onto the carrier. I just can't remember what his call signal was, but and then Maverick and Goose get called into the commander's office, and he says, Your mind is writing checks, your body can't cash. Well, I realized a long time ago that my mind is writing checks playing hockey that my body can't cash. So what I do now is, a couple hours before I'm going to go play, I'm stretching and my back, my legs, I'm doing everything. And my wife looks at me like, What do you think? You're playing in the NHL? You spend 2 hours on the floor stretching while you're watching hockey or something? Well, what am I going to do? So played the usual game, and by the end, when you're playing, there's not a lot of guys on the bench, so you're just constantly in, and it's 90 minutes running time. It's just brutal, and by the end, my body's just shot. But it feels great though, right? You're on that high because you're just so wiped out. So, but by the time I get home, and by the time I unwind, it's 3:30 and 4 o'clock, and I'm going to bed. I get home at 1:45, and I'm maybe 2 if you stuck around and talk to the guys for a little bit. And then, you're all jacked up. So you're just playing, just trying to unwind. So by the time I get up Saturday, it's, 10 o'clock or so. And I did my normal puttering, and it was a nice, relaxing weekend. Anyway, my cousin who lives in Tucson texted me Saturday, and she said, "Have you seen the new Sebastian Maniscalco comedy show on Netflix?" I said, "No." And Sebastian Maniscalco was born and raised in Chicago, I think Arlington Heights, Illinois, and Chicago, New York, very similar. You have your bunch of characters and stuff, and he's Italian, and he's a very funny comedian. And I've been watching him for years now, but I didn't even know he had a new show out. And so my cousin said, "You should watch it." And so last night, my wife and I watched it, and it's one of these where once I get going with the laugh, it's done. And it's very funny because Sebastian Maniscalco he was raised in an Italian household, and with his parents and his grandparents, and he talks about his childhood, how it was so funny that he was everything in their household was yelling. It was there was no conversation, there was no touchy-feely. It was about food, and it was about yelling. Not a very close-minded childhood. His parents were, and for those of you who have listened, and if you haven't listened, I was raised by my Italian grandparents from my mom and I. My dad, I didn't really know. And my mom and I, from the time I was up until about 7, lived with my grandparents, and then my mom passed away. So I was raised by my grandparents, who were salt of the earth people, not educated. I think they went up to the 7th grade. And my grandfather was a longshoreman. My grandmother was a seamstress. And the most important thing was having clean clothes and food. That was the topic of everything. And my grandmother was a phenomenal Italian cook. And but there was no discussion, there were no conversations, there was no talk of the world and of current events. I didn't even know that stuff existed. And the way things were handled was yelling. And it was like yelling out of love. It was just everything. And if you watch Sebastian Maniscalco, he tells this story, and as I'm watching it, it was just like his childhood was very similar to mine, but not a lot of open-mindedness. And as I have progressed throughout, my adult years and in my profession throughout the years as a hedge fund analyst, later on a PM, and then a partner, and all that stuff, hidden in me somewhere, and I never knew it, but was this voracious appetite for understanding the world and understanding geopolitics, and it really was something that just resonated with me, and I became a voracious reader and watcher of documentaries, just trying to educate myself for all the stuff I didn't do when I was a student just getting by throughout all my years of education until towards the end of my career, my college years, my second go round. But it was something that I've always followed, and I think you've heard me say I'm a big John Batchelor fan on WABC radio out of New York, but he's syndicated, and I've been listening to him since 2001. And for me, it was like a master's in geopolitics. It still is. I don't think I've missed a part of his. I've missed parts, but not a day that goes by that I don't listen to a John Batchelor radio program, either live or in podcast form, because he has a podcast. But it's just been something that's been a very important part of my education over the last 18 years, I guess now. And he has several guests on that I like. And one of them is Professor Stephen Cohen, who was a professor at Princeton and NYU, and on Russian studies. And he's just really a fascinating figure. And I actually went to go see him. My friend Mark called me up, said he had some tickets, and I went and saw him this week. And I'm going to talk about that in a minute. Excuse me. He just wrote a book called War with Russia, From Putin and Ukraine to Trump and Russiagate, that I think is very interesting. So we'll talk about that in a minute. But one of the things, he had a guest on this week that I was listening to called Gregory Copley, and he's the editor and publisher of Defense and Foreign Affairs, and he has a new book out called Sovereignty. And the topic was fascinating. It was about short-termism and long-termism, and about strategically thinking short-term versus long-term for governments and nations and how they think about things. And it's as I equate that to investing, I think about the such short-term nature of everything. And I understand it. Look, you have to change and adapt. But in the U.S. financial markets around the world, but specifically the U.S., you have the quarterly reporting, and the game is beat estimates and try and raise estimates. But everything is focused on the short term. If you think about how complicated it is to run your life or run your business or run your, if you own your own business or you work as part of a bigger organization, right? Nothing is down to the penny every 3 months. Things change. They happen all the time. And, I don't know where this all started, this just focus on every quarter. I think back to when I started in the middle-ish latter part of the 90s in the investing world. Information moved slower. Didn't have the internet at your fingertips like you do. You didn't have the emails. They were there, but it wasn't as prevalent. We used to use fax machines on stuff. I'd have to go to the New York Library and get copies of annual reports. I'd have to call companies and ask them to email me annual reports, and I'd get them in the mail. And it was, exciting. I'd spend my weekend reading those annual reports, hard copy, quarterly reports, hard copy. Everything wasn't right there. And, while you could say, wow, that was kind of like the horse and buggy days, information wasn't just so there and people were processing it so quickly. And, I'm not a big fan of the financial media on TV. In my office, I have a TV in front of me. I rarely turn it on except when I want to see, just say, okay, what are they saying about a certain topic? I have a Bloomberg terminal and I see what's going on in the world. I'm reading the news and stuff like that. So I stay current reading my own stuff, my own, the sources of information that I use to help me out. But I had it on this morning. I wanted to see, because I was listening to Gregory and John talk last night I don't know if it was recorded last night, but on the podcast about short-termism versus long-termism. I said, short-termism, let's see what CNBC is saying. And I turned it on, and there they are, the anchors, breaking news, talking about Caterpillar's earnings. And I get such a chuckle. Breaking news. A company reports earnings. It's breaking news. And the anchors are reading it on the fly, right? They're reading about Caterpillar, and they're talking about it, and they're looking at it, and someone that fed them, I'm sure, what the estimates were. They're reading some site that told them what the estimates were. And as they go, they're reading through it. Now think about Caterpillar. I don't know the market cap, but tens of billions of dollars. A global machinery company. And here are folks who are not expert at Caterpillar. They're going to be on to the next company in 62 seconds, whenever the next segment is. And they're talking about it and opining on it. And so they're telling you about what it is and trying to tell you the importance of it. And then they bring out another expert who says this, another guy who says, I don't own it, but it's a cheap stock. It's a cheap stock. It's trading at 11 times earnings, got $8 billion in cash, free cash flow yield. What value does that add? What does that mean? It's a cheap stock. Why? Because its PE ratio is low. First of all, it's a deeply cyclical company, and this isn't about Caterpillar. And that adds value by saying it's a cheap stock. Everyone can see what the valuation is. The next person comes up and says, well, the risk reward's not as attractive because the stock's rallied 20%. So there's not it's not an attractive here, or as attractive as it could be. What does that mean? That's the price. Price is what you pay. Value is what you get. It's what you're. So here you are in this little vignette, this little 60 seconds. You have a couple of anchors who don't follow the company, giving you up-to-date information on breaking news and maybe what it means. And you have another guy who doesn't own it, but it's cheap. And then you have someone else saying, well, it's not a really great risk reward. That was a complete waste of time. It was a waste of breath. But it feeds into what this market has become, short term. Right? It's all about the short term. That's what's so important. And I talk a fair amount about geopolitics, and I spent a lot of time with my subscribers on a podcast I did for them about the role of geopolitics in investing. And I think there are a lot of parallels that you could draw between geopolitical strategy and investing. And there is a distinction, right, between the short-termism and long-termism when it comes to really questions of strategy and the strength for the great powers of the world. If you think about the U.S., it's all about short-termism. Right? And if you think about just how things change so quickly and in the short-term nature and immediate gratification, it influences policies, right? And over time, you could say, well, that kind of puts you in a weak position thinking short-term. Because really, when you're thinking about strategy, and I know how companies think about strategy, it's about the long term. And companies are trying to balance what's best for the long term with having to meet earnings to the penny over a 3-month period where anything could have happened. A few customers pushed out an order. The cost of goods went up near term. But that's going to influence dramatically. It could dramatically influence the stock price. But when you think about what strategy is, you got to think long term. Where do you want to take your country? Where do you want to take your company? You got to define goals into this like indefinite future. Strategy, it's more than short-term trends. It's more than short-term issues. It's more than short-term problems. And when you have a longer-term strategy, you then become active. You control the narrative. When you're focused just on the short term, you're really focusing on reactiveness. You're reacting to what's taking place because you've got to serve a different God. In this world, it's the investing gods. But companies need to try and look beyond really what the immediate short-term issues are for what's the greater good. It's hard to do. There are some companies that can do it. Right? You think about what countries want to do. Countries want to take the narrative, create the narrative, control the events. Right? Where short term, where you control the events. You don't know necessarily where it's going to go in the short term, but it helps you come up with a strategic plan. And as you see, as people become more and more short-term in your thinking, then you're guided by all these day-to-day activities, quarterly reports, right? How did we do this quarter? Now, it's hard because in the U.S., and it's starting to happen elsewhere, shareholders don't want to wait. No one's really looking at the future. They're worried about the immediate time. The corporate managers. How's it going to affect my bonus? Am I going to get my raise? Am I going to get my next job promotion? Now, when you think about it, though, so we think the U.S., other Western countries, think about the next fiscal quarter. Think about who our global competitor is. China. They think in terms of the next century, the next 50, the next 100 years. That's how they're thinking. I think about the world of uranium. They're not thinking about 20. There's a great debate, well, the Chinese are going to start new reactors. They haven't done it in 18 months, right? But they've got tens of them that have come online recently and under construction, and they've got a lot of uranium stockpiles because they're not thinking about the average U.S. utility or Western utility holds 2 to 3 years. They want to hold decades of it. They're thinking about where are we going to be 50 to 100 years from now. And if you think about the great powers, they're built on this long-term sense of who we are, where we want to go, what's our vision, based on who they are, what's their identity, right? Based on their belief in their own culture, their history, their ability to trade. And if you think about like global economies, right? Who are globalists? Well, globalists typically are urban in the US and Europe. And then who are the nationalists? Close the walls, protect the border. They're more rural, driven more by this identity. You've heard me talk a lot about populism and the rise of populism around the world. Right? Globalists think in terms of no borders. It's one big planet. But as the world becomes, especially in the investing world, becomes like this series of short-term events, right? As Greg Copley says, globalism is a concept that's really viable in times of peace and plenty. And then when you don't have peace and plenty, then you don't really think in terms of being global. You tend to see a rise in nationalism. And he talks about reality as history. It's cyclical. And in all stages, there are dislocations, whether it's an adverse power, the economy collapses. And when you tend to see those things, people become defensive and they scramble for their own interests. And you see it time and again through history. And there's this divisiveness. You can look all around. I mean, look all around Western Europe. You're seeing it here in the US. You're seeing this rise in nationalism. Right? So when you think about globalism, you have to ask yourself, is it sustained indefinitely? John Batchelor threw in a great line. He said, yeah, the kind of trees grow to the heaven type of thinking. And he talked about being in for a nasty surprise. And talked about the late 19th and 20th century. You had this big rise in populism, and this industrial revolution, and all this stuff happened, but people weren't prepared for what was next. World War I. And so when you think about investing, you think about companies that you're investing in. How are they preparing themselves? Do they have a Chinese mentality, or thinking of the next 50, 100 years? But even the Chinese have been caught up in this short-termism lately. Deng Xiaoping, he recognized that the utopianism of Maoism was a complete and utter failure. And then they've kind of moved it along, moved on to still communist, but they needed to generate an economy that was a market economy. And once that happened, it became kind of like a drug. And then as that started to evolve, the Communist Party had to give freedom to the Chinese population to trade, to go buy stuff. They became enormous consumers and producers. And then they kind of just became like a Western market economy. But they started to build this huge economy, growing really fast, because that's how you get to become a global power. But now what's going on there is President Xi is trying to rein that all in, because it's kind of hurting them strategically. They're under attack. Look what's going on with the U.S. trade wars. And they don't want to lose control of the population. They don't want to lose control of the economy. He's trying to keep the economy viable. But what he's trying to do really is reverse this short-termism that came along with becoming addicted to consumption and production, just like all these Western economies. And he's kind of bringing them back to the sense of identity and bringing the Communist Party back to a sense of nationalism. And if you think about what's going on in Russia, there's a huge move towards nationalism. And Russia's really, from a strategic standpoint, doing quite well. The economy's better. For agriculturally, world-class technology, defense capabilities, very, very good. They've really reduce their dependency on just natural resources and oil and gas. And it's interesting from a standpoint of who does Russia align themselves with? And right, because you've got the U.S. and China. And if you think about to the first Cold War, you had this Chinese-Soviet split. Not now. Now the anti-Russian sentiment here in the U.S. is driving the Russians into China's arms. And they're kind of stepping back and waiting to see if the U.S. or China dominate globally, who's going to come out. And Russia's strategy is be the last man standing. They want to be a great power again. And they're very, very smart, very shrewd, strategic thinkers. Have overcome a lot in the last couple of decades. I think about it in the world of uranium. I've said this. When I spoke publicly in June of 2017, I talked about the geopolitical tool of energy that both China and Russia use, but Russia in particular in the world of nuclear power, and how they are using their dominance in reactor building, financing reactors in all stages of the fuel cycle, buying mines globally, their natural affiliation with Kazakhstan, the largest producer of uranium in the world. Strategically, talk about thinking long term. In the United States, the largest consumer of nuclear power in the world, about 30% of nuclear power is consumed here. It's 20% of the U.S. electric grid. The U.S. has gone from producing almost all of its own needs for its 50 million pounds of uranium to fuel the nuclear reactors, to fuel the nuclear navy, to make the bombs. We're self-sufficient. They could mine it, they could convert it, they could enrich it, which is what you need. It needs to be enriched. Fabricate it, and then put it into reactors. Today, they produce 1 million pounds. They use 50. What kind of strategic thinking was that? What short-term narrow-mindedness went into letting your entire nuclear fuel cycle, something so critical to national security, fall by the wayside? How'd that happen? They weren't playing the long game. Not by any stretch of the imagination. So it's look, as investors, you're looking at your portfolio every day, every week, every month. One of the things I really try and do is not pay that much attention to the prices every day, because the prices will move based on sentiment. The prices will move based on near-term events. But what you're looking for is companies, industries where there's inflection points, or companies where they have a long-term strategy. And occasionally you're going to have a hiccup there. So when you're thinking from an investment standpoint, and again, this podcast is not for institutional investors. This is for retail investors. So just like long-term or short-term strategic thinking plays a role in countries and their fortunes or not, think about the companies you're investing in and what role and strategically how they're positioning themselves. It's important. Listen, read an annual report, listen to some conference calls. If you're and it depends on what your investing style is. Are you a trader? You want to be in and out? Then that's not of interest to you. It's short-term stuff. That's fine. Some people do that. If you're putting together your own portfolio to own for a long period of time, understand when what the company strategy is. That gives you the opportunity when the short-termism of an earnings miss, the stock's down 20% or 15%, is it a better buy or not? Have they held true to what they're trying to do? Have the fundamentals changed that over a period of time are going to get them to where they want to be? And does it make sense where they want to go? And was this just a knee-jerk reaction to the market? Because if you don't have those ideas and answers, you're going to be reactionary. If you do understand and you think it's temporary and a hiccup, you can be very active in the management of your portfolio. So I equate a lot of what you think, what you see in the world of geopolitics and how countries evolve. Same with companies. How do they have strategically think? I think, and it's very important to understand that. You're seeing a lot of in the UK. You're seeing it's a mess with Brexit. The plan can't get through Parliament. They're going to go to a second referendum. It's going to be a hard Brexit or something in between. But if you think about the UK, I mean, Europe is sinking. Europe's a mess. Western Europe is a mess. Demographics are poor, loaded with debt. And I love going there. It's wonderful, beautiful. The history's great. But the UK needs to get out of there. European economy is a mess. The IMF just came out and lowered estimates. France and Germany's economies are a disaster for 2019. When Germany leaves, it's more of an issue. When the UK leaves, it's more of an issue for the Germans than the French, but still bad for both of them. But for the UK, they have to become more of a global trader, not just a EU trader. They have to go back to what they were. They were a global power. Economically, they're a maritime state. You can still do deals with the EU, but they got to set about doing all sorts of trade agreements with Canada, New Zealand, the US, India, and try and get away as much as they can from the EU. Now, it's not to say they can't do business with the EU. They can negotiate all sorts of bilateral deals. But those are bigger companies. But you got to take the short-term pain. A month, 6 months, a year, 18 months of that kind of uncertainty that comes along with it. If you want to build a long-term economy, a strong economy, getting back to what you do, opening up your possibilities. You've got, about years ago, they were a much greater proportion of the world economy than they are now. So what happens if the stocks sell off on all this fear? As a contrarian investor, to me, that fear creates opportunity. So instead of thinking, maybe the UK is it's a mess. I don't want to be anything to do with that. My God, they don't know what they're doing. Well, what are they trying to accomplish? So why does it matter to understand the geopolitical role and history? Well, maybe it's not such a bad thing. They're going to get hammered for a little bit, but at the end of the day, it's going to open up more possibilities to them. And ultimately, that's good. That's a more long-term strategy. But the short-term pain is not picked up in that. So I mentioned I went to see Stephen Cohen with my buddy Mark. Really interesting guy. He has incredibly bright. He's often vilified in the press for being a Putin apologist. He's a guy who was raised in Kentucky and Indiana, and went to live sometime. He went to college and then lived in Russia, and he's a Russian studies scholar. And his view is, listen, it's the demonization of Vladimir Putin. It's really almost at like the McCarthy era, and how dangerous that is for the U.S. and how Washington has made a lot of policies that are influenced by demonizing him. Now, again, this isn't my opinion. This is somebody I went to go see, and I go back to the Sebastian Maniscalco, right? Having a closed mind to things doesn't, one way, but thinking about the world 360 is pretty interesting, and hearing people with a different viewpoint is very interesting. And Cohen talks about the demonization of Putin, it not being a policy, but an alibi for not having one. If you think about the narrative, Putin's an imperialist. He's a Russian imperialist. He's really just a KGB apartchik. He's a brute, controls a cynical place. You got to prevent the darkness of Putin's world from befalling more of humanity, is the rhetoric you hear coming out of Washington. And he goes on to talk about how the mainstream media have played this prosecutorial role in the demonization of him. And he talks about the Washington Post and the fear that Putin exerts over the people. And he makes the point that vilifying Putin has become a canon in the orthodox U.S. narrative of the new Cold War. And it's bipartisan. Obama, Clinton, Bush's. McCain was not a huge fan. His point is that, this is Stephen Cohen's point, is most of the allegations against him are substantially uninformed, based on unverified sources, motivated by political grievances, including those of Yeltsin-era oligarchs and their people in the West. And the way he approaches it is by identifying and examining the pluses and minuses and understanding who he isn't. And he talks about, he gives you the background of the democratization really began and developed in Soviet Russia under Gorbachev from 87 to 91. He goes on, Cohen's point, he goes on to say that Yeltsin's the one who's repeatedly dealt that whole Russian experiment with the wall falling. A lot of really bad blows. And he goes on to say they used tanks in 93 to destroy what was Russia's freely elected parliament and the whole constitutional order that made Yeltsin president. He had a couple of really bloody wars against the little tiny breakaway province known as Chechnya. Enabled a really small group of Kremlin-connected oligarchs to just go in and plunder Russia's richest assets, which really just plowed 2/3 of the people into poverty, misery, and really destroyed the Soviet middle class. He points out that Yeltsin rigged the election in 96. And what he's trying to say is a lot of the groundwork was laid. He goes on to say that he doesn't think Putin made himself this czar or Soviet-like autocrat. This wild despot with absolute power to turn his will into policy. He points out the last guy who did that was Stalin. That was 1953 when he died after a 20-year reign of terror. He points out that if he really is this cold-blooded, ruthless autocrat, the worst dictator on the planet, as he's called by some in the West, then why were there tens of thousands of protesters repeatedly in Moscow streets? You wouldn't have that if that were the case. You wouldn't have the right to protest. He points out that he agrees, like other political scientists have, or he says other political scientists have agrees that he's a soft authoritarian, governing a system that has some authoritarian and some democratic components that were inherited. He strongly disbelieves that Putin reveres Stalin, that he's a gangster in his shadow. He points out that Stalin's Russia was as close to unfreedom as imaginable. He points out that in today's Russia, apart from varying political liberties, most citizens are free to live, study, work, write, speak, travel than they've ever been. He didn't create, according to Cohen, the post-Soviet Russia's kleptocratic economic system with its oligarchs and all that widespread corruption. He points out that this took shape under Yeltsin during the shock therapy privatization schemes of the 90s. That's when the swindlers, the thieves, he calls them, started to emerge. Points out that he's adopted a number of anti-corruption policies over the years, and they've been successful as a subject of legitimate debate. So there are different ways to think about this. It's just another viewpoint, but from somebody born, raised here, spent time there in Russia, looks at the mainstream press and tries to filter it. Whether or not his view is correct, who knows? But it's a different point of view. And he talks about how this Cold War 2.0, is more dangerous than the prior Cold Wars, than the prior Cold War with Russia. And you think about what I was saying earlier. While Russia was so dependent on oil and gas, they've improved their agricultural sector enormously. They've improved technology, defense development. It's not just an oil and gas economy anymore. They're kind of waiting on the sideline. Who are they going to align more with? The Chinese, the Americans? It's hard for the Americans. And his point is the fact that there's this McCarthy-esque type feel makes it difficult for anyone, right? Russiagate now, collusion, the elections. Right? You can't even mention the word. That if Trump was to show any propensity to do anything to foster positive relations with Russia, he's accused of being a puppet. He's accused of being an agent, a spy. Think about that. And his view is nothing can be worse than having a sitting U.S. president not developing relations with Moscow. That it's an incredibly dangerous thing to do. All sitting presidents have had meetings and discussions, whether they like them or not. But at least there was discussions, whereas now you can't have them. If Trump has them, he runs the risk of being called his puppet, Putin's puppet. Cohen thinks that's incredibly dangerous. I was noticing right in the press in the last month or two, right, Venezuela is a disaster. It's in turmoil. But the Russians have agreed to several billion-dollar deals with them. They're going to be locating bombers there talks of a permanent military base not too far from our shores in the U.S. Remember last time that happened? A little bit closer to home when it was in Cuba, but still, this hemisphere. What are the implications of that? The way I study it is I studied the geopolitics of Russia and energy policy. That's how I express the views too. Right? You can't look at everything, but trying to understand stuff and understand as it unfolds what's the relationship between Russia and China in the nuclear power world. The two who dominated. What are the implications for that? There's no conclusion to this, but it was a fascinating talk. Dan Rather was there. He's friends with Dan Rather. It was at the 92nd Street Y in New York City with his wife, Katrina Van de Heuvel. I'm sure I got the name botched, but she's the editor of The Nation, and she moderated it. And it was Steve Cohen and Dan Rather on stage. 150 people maybe in the room. It was fantastic. A different view. My buddy Mark walked out here. He said, just like there's so many things you don't really think about. And that's true. So, think about all these different things. Short-termism, long-termism. What's the impact on a portfolio? Does it create investment opportunities? Does it cause you to want to sell something? Understand the context of things. And talk about understanding the context of things. My guest today is Jamie Keech. And Jamie is a friend of mine. And for full disclosure, Jamie and his partner, Chris McIntosh, who runs Capitalist Exploits and their other newsletter, Resource Insider, personally made an investment in and set up an investment vehicle to invest in my investment vehicle on uranium. Full disclosure on that. But Jamie and Chris run a natural resource newsletter in addition to Capitalist Exploits called Resource Insider. That is fascinating. Jamie's a mining engineer, so he brings industry perspective. And we're going to talk about natural resource investing and how to put context around what you think you know and give you some ideas about what you should know. So with that said, I'll bring Jamie on and we could talk about natural resources. Jamie Keech, welcome to the podcast. Thanks for coming on.
Thanks for having me today, Mike.
So you and I have been speaking for a while, but we actually met for the first time last week in Vancouver. We had a beer at the Cactus Club.
Mm-hmm. So, yeah, I was trying to do the math on that, and I think it's been the better part of a year now that we've been working together or talking about working together in one form or another.
Exactly. And full disclosure for listeners, Jamie and his partner, Chris McIntosh, put together a separate investment vehicle that invests in my uranium investment vehicle. So just full disclosure, so you know that from the outset. But Jamie, it's when you and I had met Chris before I met you, and your partner, Chris, who is a great background. He's a venture capitalist. He's a fund manager. He's a newsletter writer with Capitalist Exploits and a great thinker, big macro thinker, long-term strategy thinker too, many years into the future, and cynical, which I like, but cynical not. But cynical in a great way, because I'm cynical and I'm skeptical, and I love speaking with him. He and I could talk for hours about stuff. And then you and I met, and when I saw Chris's work and I started reading it, and we started talking, did some resource stuff, and then he really wanted to expand that and open it up and go deeper. And that's when you and he joined forces and launched the Resource Insider. And as I started talking to you and learning about your background, I thought, wow, this is great. This is what retail investors really need. Somebody who comes from industry, somebody who's been there, done that, and not a journalist, newsletter writer who's just, going to listen to management and going to take what they say at face value, because that so often happens. And I think I was saying it on a podcast last week, but you and I were in Vancouver. You live there, but I was there for the Vancouver Resource Investment Conference, which you and I both spoke at. And I was saying it's a great venue. I think they got 8,000 or 9,000 people that come to this convention hall, and companies are there, and it's wonderful because retail investors get access to company management teams that we as institutional investors get access to on a regular basis. So it's nice. The flip side of that is, of all the industries I could think of, with the exception of probably biotech, it is a showcase, and not just that venue, but these companies, most of these junior mining companies, are in the business of finding and exploring and developing projects. But to do that, they need capital. I hosted a panel, and I talked about in the uranium space in the last decade, there have been 4 big discoveries, and between exploration and advancement of the projects, $50 million was spent on average, which was more than the market cap of those companies. So they had to go out and raise capital, and as you and I know, most exploration doesn't lead to anything. So there's a need for capital, though. So that's where investors can get run over. And I love the fact that your background, you're a mining engineer, and you've been there, done that, seen it, have lived in far-flung places. I know you have a fondness for Mongolia, and and other places. But talk about, and you gave a talk about what to look for. So talk about your experience as an industry professional now on the other side, on the investing side. But talk about, as you first give listeners your background, but then kind of walk us through life as a mining engineer in these far off places, and what you see actually happening versus maybe what investors get told sometimes. So tell us your background.
Yeah, so I think you raise a very good point, Mike, and I think people need to be cognizant of, and very rarely are, that many of these companies are looking for capital. They're not looking for mines, and the majority of their energy is spent on raising money and acquiring more money, and spending it in convincing ways. And very few are actively are really, really motivated to make a discovery or to develop a mine or build out a mining company. Way less than you'd think, and it's very disconcerting rather. And you say this is an industry that's probably more opaque, and investors have a higher chance of getting run over than anything you've seen.
Yep.
And I come from the mining industry. I've spent my entire career there, and this is not something I realized early on in my career. And to your point, most people in the mining industry don't realize it either. The average person in the mining industry is not a promoter. They're not the CEO of a junior company. They are an engineer, a geologist, an accountant, some sort of technical trade, and they're working on a mining project. They're working for big consulting groups. They're working in exploration projects in the field, and they're quite hardworking, noble people. They spend a lot of time away from their families and friends and everywhere else they'd want to be, in often remote and very hostile places that are hard to work. And it's too bad, because those are not the people most investors or people familiar with the industry from the outside ever get to see or ever get any exposure to. And those people, of which I was one for a very long time, have very little concept in general of the investment side of the industry and how it's often promoted. So I spent the first 10 years of my career working in industry. As you said, I'm a mining engineer by training. I have an undergrad from the University of Toronto, big university here in Canada. I did a master's at the Camborne School of Mines, off in the UK. And over the course of 10 years, I've worked in exploration, I've worked in development, so building new mines, and I've worked in operating mines. And I've spent time in Albania, in Mexico, in the United States, in Canada, in Hong Kong, in Mongolia, throughout Latin America, Colombia, Peru.
Don't forget Albania.
In Albania. I spent the better part of a year there living in what could generously be described as a tent with walls, with hard walls on the side of a remote mountain there. And most of what you're doing is, I mean, depending on which stage you're at, but you're in the field every day, and you're looking for a mine, you're building a mine, or you're operating a mine, and that's your focus. And it's like any other trade or craft or profession, you're looking to do the best you can on that. And it's a totally different world from what is happening at these conferences here in Vancouver or Toronto or what have you. And there's such a disconnect between the people that work on one end and the people that work on the other end. And I was totally unaware of it. So I mean, I always worked on these projects, many of which were for earlier stage companies. And I kind of figured, if you do a good job, if everyone in the field is doing good work and providing good information and data, what would obviously happen would be a good company would be created, a great company. And that company would then, of course, go on to create tremendous amounts of shareholder value. The stock would go up, everyone would make money, we'd get bonuses, and we'd all be happy. And as you probably no doubt know, that was very rarely the case.
Mm-hmm.
And it wasn't until so about 10 years in, I decided I wanted to move more to the business side and start building these companies and working in the startup sort of stage. And I moved to Vancouver, and I had the chance to work with a variety of groups, some very, very good ones and some less good ones. And I got to see firsthand how a management team structures a company and how they've set it up can really determine whether it has a chance of being successful and creating value for shareholders, or quite the opposite, whether it can completely swindle people in terms of just sucking capital out of the company and making management rich. And it's very easy to do. One looks very much like the other in the early stage if you don't know what to look for. And that's probably, whether management realizes they're doing it or not, what the vast majority of these small, TSXV listed companies end up doing.
You just said something that's so interesting. So, and I brought this up on on my podcast last week when I was talking about the management teams. I said, I don't think most go into this as liars, as cheats, as swindlers. I think most believe they have a project or two or three, and that they believe that by putting the drill in the ground, they're going to find something. And I think more often than not, that's probably the case. I don't think people are inherently bad. However, there's a fine line between, they know the chances of discovery are very low, and yet they've got to put a glossy presentation together to talk about why this project is so terrific. So can you talk about what you just said, the distinctions, because they kind of look alike? How does one look versus the other?
Yeah, so I think, in life in general, but definitely in mining, you should be careful not to confuse incompetence for malice. And they often look a lot very similar from the outside. And, you need to think of it from the perspective of the average mining CEO. They're, typically an entrepreneurial type. Maybe they're from a technical background or a business background. Maybe they just got into this from being a broker or something. There's all sorts of people in mining, and how they get there, I never seem to be able to figure it out. But even if they're trying to do the right thing, what they've typically done is they've gotten this project, and it might have looked very good. And especially if they're non-technical, they've probably relied on the judgment of a geologist or other technical people to say, look at this project, let's call it this gold project in Mexico. It looks great. It's got these great geophysical anomalies, and there's, soil samples and chip samples, and everything is indicative of there potentially being a deposit there. So what they do is they raise a bunch of money on the back of this. They put their own money in, hopefully. They've probably convinced some of their friends and family to put money in. And Then they go out and do some work, they drill it, and it doesn't quite get the results that they hope they get. And what you typically get, and I mean, if it's a complete failure, if there's nothing there, that's one thing. It's like done and on to the next. But what normally happens is people get these like, it wasn't the 10 out of 10 they were hoping for, but it was a 7 out of 10 or a 6 out of 10. And at that point, if you were going to go into it fresh from that point, you probably wouldn't choose that project. But at this point, you've taken a lot of people's money. Your career is dependent on this. Your friends and family are looking at you to make that money back. You feel a lot of obligation to your shareholders. So what you're going to go out and do is promote this project with probably the rosiest picture that is legally possible, because you will convince yourself that, if we just get a bit more money in, we'll do a bit more work, and it'll prove to be better. This is just a slow patch. This is, it's like you get this scope creep where people start to think like, if we just do a little bit more, or, okay, it's not quite what we thought it was, but if we rejig it a little like this, it'll actually work, and maybe it can be a mine. And you get these people whose their incentives are so skewed to making that project work that, I mean, they can believe whatever they need to believe to push it forward. And the problem is you build it up and build it up and build it up, and then finally it hits that wall, and then you have a catastrophic failure as opposed to an easy exit. And it's a really hard position for management teams to be in, because what do you do in that position? Everyone likes to think that they would take the high road and bow out gracefully or shift the focus of the company. But, there's a tremendous amount of pressure on these people. There are often very powerful investors that they're relying on. And yeah, it's a really complicated situation.
I hosted a panel when we at the conference with exploration companies, and I asked about how you find the capital and how do you allocate the capital, and then the third question was, at what point do you decide I might not be onto something here? And you just said that's the hardest part, because you feel like if you just keep drilling. I've heard so many stories of big discoveries where somebody bought a project from somebody else because somebody else couldn't find it. They stopped drilling, yet a few meters away they put the drill in the ground, and there it was. So it's as a geologist, as a mining engineer, it's got to be so difficult to, or as a geologist or as a CEO of a company, or a mining engineer comes in later. But when do we stop? Because we're close, we could feel it.
The thing is, discoveries are so hard and so unlikely. So it's something like 1 in 4 or 500 very, very prospective targets ever becomes a mine. 1 in 4 or 500. Yeah. So most geologists never find one. No, most geologists never even get close to finding one. And the problem is, for people to survive in this industry, they have to be pretty much ridiculous optimists. They're really fighting the odds. So the personality type that it attracts is the ones that are extremely self-convinced and, despite all odds, are able to convince themselves it's, just around the corner. It's just that next drill hole.
It's funny you say that. I've never met him, but the legendary mining Lucas Lundin, the legendary miner, was being interviewed by Grant Williams on Real Vision. And Grant's, I've not met Grant, but I love his program. And he was talking about, and he said, I am the eternal optimist. I mean, if this project doesn't work, the next one likely will, basically, is what he said, right? He said, you have to be like that when you're in this business. And you're right. If you're a skeptic, you'd be pulling the plug right away, I suppose, right? If you're not believing in what you're doing. It reminds me and I often equate mining to biotech companies. A cousin of mine who I grew up with is a PhD something, but a lot smarter than me. He works at a major pharmaceutical company, and he's in drug discovery and the central nervous system stuff. And we talk, and he tells me what he's working on, and Of course, we joke because I have no idea what he's really saying because it's so complicated. But I talked to him. I said, wow, you've been working on that for years, and he'll say, look, guys go their whole career, brilliant scientists, and never have a discovery, and it could be years later or nothing. But you're in the business of exploring for cures, and but he's optimistic, most of the time, and he has to be. He feels like he's always on to something. So it's very similar. And the way, biotech companies are always looking for money because their research and development expense is just like a miner's drilling expenses, right? They're exploring.
Yeah. And I actually think that's a very good way of thinking about the mining industry, especially the early stage, especially the exploration stage. And this is something I talk about with our subscribers, with our members, is that you really need to remember that these people are scientists. And typically in exploration, what they're trying to do is, they develop a hypothesis, a thesis, and they're trying to prove that thesis. And if it works, if they prove the thesis, they can make hundreds of millions of dollars for their investors, billions of dollars. The problem is it's very expensive to test the thesis, and most of them never work. So, it's not like being in a lab where you have some chemicals and mix it together, or you perform an experiment. It's going to cost typically millions, if not tens of millions of dollars in drilling, and only then do you know you're wrong. And that is a successful exploration project. That's how most of them are supposed to go.
So let's talk about, we mentioned biotech, and we talk about the tools that scientists have to aid in drug discovery. And those tools, and I don't follow the industry closely, but enough to be dangerous to know that you've had great advancements. Could you talk about in the mining industry over the years, what has changed from a tool in your toolbox point of view that can help geologists improve their rate of discovery?
Well, I actually don't think the rate of discovery has improved over the last last decades. In a lot of ways, it has slowed down because we've really gotten the low-hanging fruit. So someone I think of. I've had the experience and the pleasure of working with a gentleman over the last few years named David Lowell. Now, David Lowell, he's a geologist. He is probably the most successful mine finder in history. He's 90 years old. He's found something like 14 plus mines. One of them, La Escondida in Chile, it still produces something on the order of 4% of the GDP of all of Chile. So this guy has been working. He's still working. He's 90 years old. He's still flying around Latin America, Europe, all over the place, looking at projects. And so as someone who has developed a system for discovery, he's a very good example. And this is the kind of person investors should be looking for. So he became an expert in what's called a porphyry copper deposit. And these are these big copper mines that you see, especially in Chile and Latin America. And this is where really the vast majority of the world's copper come from. He developed a model, which is incidentally named after him, called the Lowell-Gilbert model, which basically demonstrated the type of environments that we would typically find these things. And what he did is he went around the world and he identified them. And these were there, but people didn't quite have the tools to find them. And more importantly, at the time, prior to about the mid 1900s, no one had the technology to properly mine and process them. They were lower grade. They needed heap leach technology and a variety of other processing techniques to effectively extract the copper from the ore at a profit. And so he really hit, in a lot of ways, like the right place at the right time. It was the perfect storm. He came up with this model. He identified these things that were at surface, relatively easy to find once you had the model. And at the same time, the mining techniques that were required to make money out of these things came along. And that's an example of sort of technology colliding to make discovery easy. But with each generation, more and more mines are found. The lower hanging fruit is sort of plucked from the tree, and it gets harder. And now we are drilling deeper and deeper than we ever have. We're mining deeper and deeper than we ever have. And so it's going to be a combination of advanced exploration techniques and satellite imaging, geophysics. All of this is playing more and more of a role of finding these. But at the end of the day, so many of these things are deep. And the only real way to find deep mines is to drill for them. And drilling is expensive, and it is time consuming, and it is arduous. And the deeper you go, the harder it gets. So I would say in a lot of ways, I don't think we're speeding up. I feel like technology is advancing and it's allowing us to keep pace, but it's a very difficult game, and it's not easy to be done. It's impossible to do cheaply, really.
The drill is the ultimate truth teller, isn't it?
I mean, it's the only way. You can look at any number of satellite and remote sensing and geophysical data, but until you get down there, until you basically use that drill to reach into the earth and take a sample, a physical sample of it, and you take it into a lab and you assay it and you say there's this amount of gold or copper or what have you, there's no way to know, or at least there's not yet.
So we talk about investors needing to just be cautious and understand when they're looking at a mining junior miner. When we think about the landscape, there's exploration stage companies, there's near-term development, and then there's producing companies. How do you think about the world when you're thinking about allocating capital, or you're thinking about making an investment in a company? What's your preference for amongst those different categories?
Well, I mean, personally, I am invested in all of these types of companies. Mm-hmm. In Resource Insider, our product that we provide, where we provide research on the mining and metals industry, where Chris and I invest our own money in our picks, and then our investors are able to come in, invest alongside us at the same price, at the same terms. We've looked at exploration stage, we've looked at producing, we've looked at developing stages, and it's a matter of having both depth and breadth. Today the mining and metals market is so depressed that you're able to find very cheap producing mining companies. Mm-hmm. They're trading what exploration companies would have traded at, 5 years ago. And so we're focused a bit more on that than I typically would have been, because we're able to get these things so cheap. And by that point, 90% of the risk is gone. And if an exploration company is proving a scientific hypothesis, which is hard and will probably fail, running a mine is it's a problem of optimization. It's a matter of getting a machine well oiled and running as smoothly as possible. So mining's a very unique industry in that you do not control the price of your product, mm-hmm. and you often only have a relative idea of how much of that product you actually have. And the only area for a company to compete really is in cost. So the companies that do the best are the ones that are able to mine as cheaply as possible. And there are two main aspects in that. There's operational efficiency, which a company can control, and then there's the deposit type. And given the shape and size and depth of a different deposit, these projects lend themselves to different costs. So going back to your question, I look at it this way. So the best explorers in the mining industry, the people that have made tons of money. So these are the Robert Friedlands, these are the Ross Beatties, these are the Lucas Lundins who you mentioned earlier. A trait that I have seen in all of them is that they always have many things on the go. Not one of them is ever involved in one project. And I think this is a trap that mining professionals fall into, and of course, investors fall into. They fall in love with a project, mm-hmm. Or an idea. And The problem is the possibility of any individual project working out the way you want it to is not only low, it's next to nothing. And the way we look at this is we really do spread our risk across a variety of projects and a variety of commodities. So, I mean, I look at a lot of gold, a lot of copper, a lot of nickel. Obviously, we're looking at a lot of uranium with you, and we're looking at different stages of the mining life cycle. And, uranium obviously super suppressed right now, but generally metals and commodities right now very suppressed right now. They're going to pop at different times, and we want to sort of arrange our exposure so that we can take advantage of that. What I really look for is companies that are well managed by people whose incentives are aligned with my own and have the ability to stick around until there is a recovery in this market without diluting the hell out of me and others and other investors.
So as a mining engineer, you bring a unique insight into being able to analyze a company. And so we take a company and it's made a discovery, and now they're going to put a preliminary economic assessment around it, and you're going to then get a pre-feasibility study, which is going to lay out the economics and the mining methodology and the payback period, the internal rate of return that investors can expect. The project financiers. What do you do? Are there any tricks of the trade from a mining engineer's perspective? Is there a checklist that you're looking at when you're reading one of these economic assessments or feasibility studies that you're looking for, the nuances that you're looking for where you think a company can be overly optimistic?
Yeah. Okay. So when I look at something, the first thing I do comes back to something I just mentioned is costs. So I look at if it's a producing mine or if it's going to be a producing mine, I look at where it's going to sit in the cost curve. And that basically means where does it sit next to its competitors in how much it's going to cost you? We'll look at gold, for example. So to pull an ounce of gold out of the ground, what is the cost going to be next to one, other gold companies, and two, other gold companies in that region? So if we're an open pit gold mine in Nevada, how much money is it going to be? How much money is it going to cost compared to the one down the road? And what you typically want to see is that this company is in the top, 20, 25% of that cost curve, that they're a tier 1 or tier 2 asset, that it is able to be mined cheaper than anybody else. Now, going into more detail, what we want to do is go through these feasibility studies and understand if the assumptions being made are reasonable. And, I caution a lot of investors that I talk to on this because I think it's very easy to fall into the trap that you can do that very well. And to give you an example, when I look at a company, what I typically do is I talk to people who are expert at that exact type of deposit and type of mine. So I'll talk to a geologist that really understands these type of projects. Say it's a epithermal gold deposit, a guy who has worked on these companies, who has explored for these, and I go through the geology with him or her, and we talk about whether the assumptions that are being made are reasonable. I look at mining costs a lot. Again, not to beat a dead horse here, but are the assumptions that are being made reasonable? There are a lot of comparables out there, and if you look at similar mines, and for some reason it's costing these guys are estimating it's going to cost them 25% less to mine a ton of rock than the guy down the road, you really want to understand why they're making that assumption and what that's based on. Again, there's a big issue with the way feasibility studies are done. And, Mike, you probably know this, no doubt, but, a company has a mine, or rather a prospective mine. They don't do most of the feasibility study themselves. They bring in a consultant, a third-party consultant that will do the engineering study. They will sign off on the validity of this, and they will make resource estimates for the company. So the third party will estimate how much material is there, how much gold is there, how much copper is there. And this seems like a great third-party system, but the problem is these people are paid by the mining companies.
Yep.
And their whole business is working for the mining company. And so if they get a reputation of, quote unquote, not being willing to play ball and to give a reasonably optimistic estimate, they're not going to get hired. So,
Jamie, I'm a fan of stupid comedies. If you ask me what genre of movie I like, it's the stupid comedy. And probably my favorite of all time, or top three, is My Cousin Vinny. And there's a scene in My Cousin Vinny where Vinny's a lawyer from New York who has to go down into the Deep South and represent his cousin and his friend who were driving through the Deep South to get to law school in California. And they got arrested. And it was a mistake, but they're on trial for their life. And Vinny couldn't find his suit. Got messed up, and it fell in some mud, and he had to wear like Colonel Sanders suit, an old Southern suit, and he's in the court, and he's having a tough go of it adapting the first week that he's down there, and he's got his head down. They're in court, and the prosecutor is laying out the case, and he's laying out why these two boys committed a murder, which they didn't, but Vinny, poor Vinny. He's like a fish out of water, a New York guy down in deep South Alabama. The judge hates him. Everyone hates him. He's considered a Yankee. He's wearing a Southerner suit, and they think that he's mocking them. And he hadn't slept in a couple of nights, so he's got his head down on the table, on the defense table, while the prosecutor's laying out. And then the prosecutor's done. He lays out why these two boys have committed the murder. And Vinny wakes up from his deep slumber after his cousin kicked him. And he looked up and he said, everything he just said is bullshit. And, it reminds sometimes, you're reading these things and you're right. They're put together by third parties. It's similar to, as my background for most of my hedge fund career has been as a short seller. And one of the things I always chuckle at is when a bull will turn around and say, when I think a company has funky accounting, they'll say, well, the auditors signed off on it. I'm like, okay, right. In the history of accounting, that the auditors, you think that's neutral and independent. Okay, good luck with that. But in this case, they are paid for. The Kazatomprom IPO, the largest uranium producer in the world out of Kazakhstan, came public. And in their IPO prospectus, they have pages and pages of industry insights, but it's not theirs. They're coming from all these other sources and other sources of information. I am you said it earlier, the power of incentives, or the methodology that goes into assumptions. And so what I find often happens is people fall into this great trap of quoting experts. And, when I look at a lot of the data, you have to look at the source and okay, what is the source's motivation? What is the source's methodology for calculating that data? Who is paying the bills of sources? And in the particular case of these studies, right, the companies are paying them. So I spoke recently at the end of October to a bunch of fuel buyers, uranium nuclear fuel buyers at the Nuclear Energy Institute in Boston. And I did my topic was basically the costs of miners. And I said, look, you guys have had a great run for quite some time now. As a fuel buyers, you've stayed out of the market. You've done a wonderful job, and the mining companies should be ashamed as they were producing during a downturn. I said, but if you look at their actual costs that they show you in those glossy presentations, their costs to mine, they're bullshit because they're not including their all-in sustaining costs. And I walked them through. I said, if somebody says they're producing for X a pound and they're selling it for Y per pound, and there's a big gap there, yet they're not making money, so they're not including all their costs. But then I said, as far as these studies go, they're dramatically understated. They're much higher than what they're telling you because they're not putting their worst foot forward in those reports. And that's, I think, where people sometimes can really get bagged is by relying on these. And like you, we also talk to people, you are an expert, but in the mining engineering, but it is so critical because I think people get a false sense of security. They use these as a security blanket, but that's just like kind of like the first step, right? It's kind of laying out the like I like to see, how much they can produce, the methodology in which you're doing it. But then when you get into nitty gritty, that's where you really got to peel the onion back and understand and compare. Like you're saying, comparison is so important. And if you're 50 kilometers down the road, why are your costs so much dramatically lower than the next guys? Yeah.
Well, it's interesting for me now being on the investment side, because previously I'd been on the company side and we'd spent a lot of time presenting to investors, and you always think that it's going to be very hard to convince these guys of this, and they're looking to say no, and it's only in hindsight that I realize that most people are looking to say yes. Their job is to allocate capital, or they have money they want to invest, and they're looking for a dream to buy into. And it's very easy to accept these things on face value because, wouldn't that be nice if they're true? If it make my job easier, and look, I can go to sleep thinking I'm going to make a ton of money, and everything's easier. And so the title of the talk that I gave at the conference was, it's a bit tongue in cheek, but I said, how you got screwed in 2018. And it's inside the rigged game you didn't know you were playing. And, a lot of what we do talk about, what I did talk about, is motives and incentives. And it's, understanding the motives of the people you're investing in, and aligning or ensuring that their incentives are aligned with you. And the motive one seems a bit, I spent some time thinking about this as I was writing it, because it seems a bit light at first, and I really went back and forth on thinking, should I keep it in there? But I think it's probably the most important thing, and it's something that I think about considerably, in that most people assume that the companies they're investing in are trying to find a mine, or they're trying to build a mine, or they're trying to create a mining company. But that is a really, really hard task to do. And again, as we discussed earlier, the odds are very much stacked against you. And what most people are trying to do is make money. And that is not a hard task to do. It's not that hard to raise a bit of money into a shell or into a company, and then to pay yourself an egregious salary, and to give yourself a bonus every year, and to issue yourself so many stock options. And that's so much easier than it is to go out there and spend, like your brother-in-law spend decades searching for something that you may never find, without rewarding yourself. And you have to find these people like David Lowell, the guy I mentioned earlier, who's found 14 mines. He's 90 years old. He's still flying around to mine sites all over the world. He's involved in a company called Solaris right now with a great copper project in Ecuador. This is a guy who could have retired as a very rich man 40 years ago. But he's gone, and he's gone, and he's gone. And in the meantime, he's made himself very rich. If you ever have the opportunity to go down to the University of Arizona, you'll see that pretty much every damn building there has the name Lowell on the side of it.
It's where I went to school. And by the way, I am not a mining engineer. I was not anything related to that. But yes, it is. I'm back there with my family probably every couple of years. So
And he's also.
By the way, I didn't graduate from there. I went my first few years there, but I graduated from a different school. But it is. It's he's everywhere.
Yeah, and he's donated. I have no idea how much, but a lot. And that is a small amount to the billions he's created for different clients, for different shareholders, and then you have the polar opposite of that. Have you been? I don't know if you guys would have seen this much in the U.S., but have you been hearing a little about this fraud that's been going on here on the CSE, the Canadian Stock Exchange, with the check swaps?
No.
Okay, man, we got to talk about this. Okay, how should I explain this? So I'll read, I got this actually in front of me. I'll read the headlines that have been coming out. So the BCSC, the British Columbia Security Commission, investigates alleged scheme run by consultants, or convicted fraud artist at center of crypto cannabis shares scheme. So what was happening here is a group here in Vancouver of quote unquote entrepreneurs. We're starting a series of companies. They started companies in mining space, exploration companies. They started a company in crypto space. They started a company in the cannabis marijuana space. All of these sort of venture stage companies where you raise money and, they're high risk, high reward, and no one really expects them to necessarily work out. And so they churned out a series of these companies. And what they did is what's called a check swap, which is not illegal, but it needs to be disclosed, and it's designed for a specific purpose. And a check swap works that if I have a company, and say, Mike, you're a consultant of some sort, maybe a geologist, maybe a marketer, maybe a finance guy, whatever, and I want to, get you working with me, and I want to align you with the company, incentivize you. You will buy stock from us, probably at a good deal, a good price, early stage. You'll send me that check for whatever it is, $20,000, and I will write you back another check for whatever it might be, $20,000. And you'll basically get that stock for free, and the money paid back will be paid back in consulting.
Mm-hmm.
And what these guys did was took that to a scale that has, in my view, never before been seen. They raised millions of dollars on this, like something like $7 or $8 million across these companies, and they paid back something like 80 or 90% of the money to these consultants who allegedly have not done anything. So say you're my friend, and I say, Hey, Mike, you want to come on as a marketing consultant? Write me a check for $5 million into this company, and I'll write you back a check for $4 million. So all of a sudden, you've put $1 million in, but you've gotten $4 million of cheap stock, which is essentially free at that point. So what do you do with free stock? Because you can sell it at any price. And they sold it and sold it and drove these companies into the ground. And now you have a bunch of poor shareholders left holding the bag for these things. And obviously the stock is worthless. There's no money left in the company, and probably they never had any idea what they were going to do with that money in the first place except take it. So it's worthless. And this happened across numerous companies. There were a bunch of people involved, and now they're under investigation. But this is like
it's sleazy, unbelievably sleazy.
Yeah, it's an extreme case, but it's a good representation of what can happen. And some of these people had very good, long-standing reputations and were known as sort of leaders in the mining space. And it's really too bad for the industry. It's too bad for investors. But I mean, it's good that this is being investigated. It's good that this has actually come to light.
So, what do you tell us more about Resource Insider? And as subscribers, what do they get? How do you communicate with them? What's the premise of it? What's the purpose of it? Share some more.
Yeah, I mean, Resource Insider, the premise is very simple. I look for things that I want to invest in. I invest in them, and I invite our subscribers to invest alongside me at the same price, on the same terms, with all the information that I can give them. And this really came about, and this came about a year ago, or just over a year ago. We started putting it together, and Chris McIntosh, my partner, who you'd mentioned earlier, he's a macro investor. He's managed a fund. He's been in the VC space for some time. He decided, for a variety of reasons, that where he wanted to be putting his money over the next 5 to 10 years was in mining, natural resources, and commodities. And he did not know how to do that as effectively as he wanted to. He told us, I could buy a major mining company, but I don't understand how to evaluate these smaller companies, these startup companies, where you really see the biggest returns on your capital, where you can see these 10, 100-time returns if you choose the right one. Yep. So he wanted to partner with someone that had the right relationships and the right technical background. And that was me. So we got put in touch through a mutual friend. We spent probably the better part of 6 months discussing what we wanted to do and how we wanted to put it together and what we wanted to go after. And we decided on what became Resource Insider was we were going to focus on private placements. And if your listeners rather don't know what private placements are, these are essentially participating in equity financings. So when a company is trying to raise money, they'll issue shares, and they will sell that to investors who want to come in as shareholders. And so it's very different than buying stock on the stock market. You're not buying it from another investor. You're buying it from the company directly. And the big advantage of this is that the company can, with some limitations, but set the price of that stock. So to incentivize their investors, they will often set it at a discount to what they're currently trading at if they're already publicly listed, or you'll be able to participate in an IPO or a pre-IPO stage, so you get in earlier than other people, or they can add on other perks such as a warrant. So a warrant is another security that will convert to a share at a set price and add that little bonus on. So we wanted to focus on private placements because we believed that it really gives us the most bang for our buck. It really gives us the most leverage for what we consider risk capital. And in my experience, this is where people in the industry actually make their money. They invest in their friends and their colleagues and coworkers' companies. They get in very early. They get these, the cheap stock, the warrants that really give them that torque that they need to make cash.
Yep.
Because they're taking on a tremendous amount of risk. I mean, anyone who invests in mining and natural resource companies needs to be cognizant that these are high risk deals. And if you're going to take on that risk, you want to have those outsized returns at the end of the rainbow. So that's what we decided to focus on. We set up a subscription service, and people can join, become members. And what a member gets is they get access to all the deals that we're doing. So we just did, I can go into detail on this now. We just closed it last week. We just invested into a company called Northern Vertex. It's an early stage producing mine. They just started up, that had been hammered by the market. They did an equity financing. It's based in Arizona. We got in there at a discount to what they were trading at. We got a full warrant for 2 years on that. And what we provided our subscribers is, first of all, detailed site visits and interviews of management. So I went down to site, I put together videos, I explained what was happening at each stage of the mining process. I talked to the guys who are actually running those stages, asked them what they were doing, so people get to see clearly what's happening there. I sat down with the CEO and the key technical people explaining, how the company was structured, what the plans were technically and financially going forward. I sat down with key investors. There were a couple of big hedge funds and financial institutions that were investing into this company. We did interviews with them. We provided that information to our subscribers. So they're really getting the kind of look that people who work in the industry, people like you and I, get to have all the time, where I can call up the CEO of a company and say, listen, we're thinking about your project, thinking about your company, tell me why. And then I get to drill them and say, well, what about this? What about that? What about, this doesn't look right. And it's a really unique, I think we provide a really unique product, and we provide a lot of information. We also provide, of course, a detailed report with every investment that we cover, explaining what we like about it, what we don't like about it, sort of a detailed risk and opportunity profile. And then I say, I'm investing X percent of my capital. If you want to do it, this is how you can do it. We don't tell people what to do. We don't take any money from the companies that we cover. So I don't get paid by any companies. I don't get finder's fees or any of that nonsense. Yep. So we only make our money from subscriptions. So if our subscribers don't want to invest in a deal, that's fine for me. It doesn't affect my bottom line. All I want to do is provide them with deals that they will find interesting and let them choose the ones that suit their portfolio. That's it.
That's great. It's funny you were saying about grill the CEOs. I had dinner last week with the management team, and after about 2 hours, they were thinking, why did I take this dinner?
Well, Mike, because even the best CEOs have a fine veneer of bullshit you have to get under before to get to the
exactly. And I want to touch on this for a moment. So when you're talking with the management team, and I will say the junior mining space is unlike most unlike many, where they court the retail investor. And I think it's great that retail investors get access, but they, especially in depressed markets, depressed parts of the metals and mining markets where they need capital. So they'll court institutional retail investors. They know they're going to get grilled more when they speak to an institutional investor. And when oftentimes I see it on Twitter a lot, I called XYZ or I emailed XYZ and they got right back to me in 5 minutes. That was great. I don't, as an institutional investor, I'm not sure I want the CEO to get back to me in 5 minutes. I want him to be busy, doing something.
Yeah.
Waiting
like
to
running a company, right?
For
example.
Right. And, because, and sometimes I have to keep perspective because I am public in uranium and I'm called upon a lot to speak. And so they reach out to me, right? So a lot of times I'm not reaching out to them, but then we get a back and forth going. But there's a confusion sometimes. Companies will see me or you. They'll see you speak publicly, and you might host a management team on a conference panel or something like that, and think, oh, you're buddies with these guys, and you're cordial and you're friendly, and some people you like more than others. The whole thing, but my job isn't to be their friend. My job is to make investors money. My investors' money, and when I'm speaking with them, of course, always polite and cordial, but it is, they're in the business. You don't get to that level, whether a junior miner or a big company. You don't get to be in the C-suite by not being somewhat of a political animal, by not being someone who can tell a convincing story. And when I'm talking to a management team, if I sense I ask my questions, I drill down, and at the first moment I get a sign of bullshit, I call it. And I think it's important, and so I do that, and I'm very frank, and I tell them my view of where I think things should be, and they could take it or not, listen to it or not. And the way I could vote is by selling my stock or buying stock, right? Yeah. That's how I vote. But I think when investors get a hold of, the retail investor gets a hold of a management team of a company, they're going to control the narrative, right? Because it's their narrative. And I think it's important for people to recognize that when they're talking to these guys, they're controlling a narrative, and it's best to go in prepared. It's best to go in with some questions. So, and I talk about this a lot, when you're doing a call with a management team, when you are doing it, what are some insights you could give to investors? Like if you could just give them a few who may talk to management teams, but a lot of times they're more impressed. And I'll tell you, it's funny because I was walking around the conference floor, and I can't walk 50 feet without people coming up to me and wanting to talk to me. And I made a joke of this last time on last week's podcast. I had a few people ask to take selfies, and my wife and kids are like, "What are you serious? Like you? Like why?" But like my wife's like, "Yeah, I know you did be the idiot you are. What are you kidding me?" No, but in all seriousness, when you're in these environments and you can meet an investor, or you meet somebody you see, or somebody who's a management team, and if you're not familiar with dealing with them all the time, you can kind of get mesmerized by what they're saying, and you shouldn't be. Right? So I shouldn't be mesmerized when talking to you or me. We're just regular people who make mistakes every day, right? We just have a framework for this is what we do, so it's our vocation. So you're a retail investor. You're kind of following the story. One of the things I noticed by walking the floor and getting approached by a lot of people who are attending is they all want to know what stocks I like, and I'm not going to tell them, right? I just don't talk about that. If I hear them saying things about companies they really like that I just think are complete bullshit, I steer them in a direction and tell them things they should ask. But what do you, if for that person who is studying and learning and getting up to speed, what are a few of the things when you get that guy on the phone or you're at that booth? What are the things, like if you could, are there a couple or three things or five things?
I actually have three that I can think of that would be great that anyone can do and will add a tremendous amount of value. So what are the incentives? Okay.
Yep.
What is their background and what are they doing? And when you talk about their incentives, it's very simple. Ask them what their average cost is for the stock that they own.
Love it.
And that's the number one thing, right? So let's look at an example, a very typical example. So, a lot of people that participate in private placements, what I was talking about earlier, a lot of, of the more serious retail investors in the mining space, they want to get in early. They want to get in the IPO stage. And that is great. And there is a lot of advantages to that. However, it's not always as good as it seems. The company may be IPOing at $1, but 6 months before they did a round for friends and family at 50 cents. And 6 months before that, they did a round for the founders at 5 cents, right? So you're already, that CEO is getting in at 20 times less than you. And this is not uncommon. This is like pretty much par for the course.
Yep.
And, you're basically, it's like a simple Pareto's distribution, right? Like the 80-20 rule.
Yep.
It's like these guys are putting in 20% of the capital and getting 80% of the return.
Yep.
And those shareholders are putting in 80% of the money and getting less than 20% of the potential returns. And I am all for management teams being incentivized to hit it big. There's got to be that sort of pot of gold at the end of the rainbow. If you want good people to give up high-paying jobs to focus on, a startup company, there should be that big win for them. Yep. But it has to be within reason. If these guys are going to make, 20 times their money right out of the gate, if that company drops to half of its value, they've still made 10 times their money and you've lost everything. Yep. So look at their incentives, look at their average price. The next thing I would say is, what are they doing? Say, what are you up to this month? Are you traveling a lot? You really want to hear that they're traveling to site, that they're spending time in country, that if they're just going conference to conference to conference to conference to conference, that is fine in a small context if they're actively trying to raise money at that moment. But there has to be more than just marketing. And you need to get a feel that they're interested in operating a company, whether that be exploration or mining or whatnot. They want to, you get a lot of great promoters in this industry, and it's an important part of it because it's so capital intensive, because it's so venture intensive, but it cannot be all of it. And you want to see that they have an interest in the operational aspects of it, that they're able to talk. Not all CEOs are technical, although as an engineer, I have a very strong disposition to technical CEOs, to be honest. But they should be knowledgeable. If you're going to run a mining company, you really do want to know the details of the technical aspects of your project. And then the last one I said was, what is their background? And are they the kind of person that is jumped from company to company to company to company to company and never had a success for shareholders? Because that would be most mining CEOs. Yep. It's like probably, probably 90% of the wealth in this industry is generated by 10% of the people, if that. And, these people are not hard to find. And find the people that have done it before, that have had successes before, and done that exact same thing before. If they've had a lot of success as an exploration VP at a company, it doesn't mean they're going to make a successful CEO. If they've had a lot of success in epithermal gold projects in Mexico, it doesn't mean they're going to be able to be successful running a porphyry copper project in British Columbia. Find people that have done this before because they're out there. Typically, the smart guys, once they figure out their methodology, they just do the same thing again. That's no guarantee of success, but it is a far, far higher guarantee than just someone who used to be a broker, got interested in mining, raised a bunch of money from his broker buddies, and hired a geologist. Because that doesn't typically work out too well.
That's great stuff. That really is. Three really important points, and they are so critical. So you're going to hear Jamie sound a little bit like he's in an echo chamber because we had a it was fuzzy for a few minutes. I'm sure you heard it, and so something maybe on his end had happened. So we called him back, and he is on a different apparatus, so it might sound a little bit different. So anyway, Jamie, those were great points. Really, really important. So how do people get a hold of you and Chris?
Yeah, our website is called Capitalist Exploits, capitalistexploits.at or .com now. And you can find more information about Resource Insider, about myself and Chris, and there's a ton of free content there, both articles on the mining and metal space, as well as macroeconomics and the big themes we're looking at. And there's also a variety of podcasts with leaders in the space. And if you're interested in being a Resource Insider member, just click on the Resource Insider link and we'll provide you all the information you need. We've got staff on hand that is free for a call. They can give you a complete rundown of our product, and you know, we're very approachable to our members. I engage very regularly with everyone on our list, and yeah, we're very happy to answer any questions and provide as much information as anyone needs.
Awesome. Well, it was great seeing you last week, and I really enjoyed having you on the podcast. I'm sure our listeners are going to walk away a lot smarter about resource investing. So we'll speak soon, and it was great catching up.
Thank you very much for having me, guys.
All right, Jamie. Thanks, man. Take care.
Take care.
Bye-bye. Well, I hope you enjoyed my discussion with Jamie. Incredibly bright guy, very thoughtful, pragmatic, gets the joke, if you will. He understands the pitfalls, and hopefully he shared some of them with you. So hope you enjoyed that discussion. I know I did. I'll be back next week, and in the interim, I hope you have a great week, and we'll talk soon. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.